Everyone says real estate is the ultimate wealth cheat code. But Warren Buffett and Ray Dalio built their fortunes in stocks, not property. So who's actually right? If you have money sitting right now waiting to be invested, stop. Don't move it anywhere until you've seen the brutal math. Let's find out. To prove it, let's look at Jake and Marcus, who earn exactly $50,000 each. Jake takes his $50,000 and buys a rental house. His mortgage costs him $1,330 a month, but he charges his tenant $1,800, giving him decent surplus cash flow right out of the gate. We'll factor in standard property appreciation over the next 20 years. Marcus takes his $50,000 and drops it all into an S&P 500 index fund. But Marcus still needs a place to live. He's renting an apartment for around $1,000 a month, which eats up most of what Jake is spending on his mortgage. After rent, Marcus has roughly $300 left over to invest each month at a historical 10% return. Both started with $50,000. Let's start the clock and see who is actually bleeding cash. For the first 3 years, Jake looks like an absolute genius. He's got the keys. He's hosting the backyard barbecues. Every month, he earns $470, and his property value is slowly creeping up. That's the magic of leverage. He's sitting on almost $60,000 in equity. Meanwhile, Marcus hasn't thought about his money once. His index fund is just quietly grinding away in the background. With his initial $50,000 and his $300 monthly drip, his portfolio has crossed $78,000. Zero effort, zero stress. But right around year 3, the landlord dream shatters because Jake's $470 isn't profit. It's an illusion. Out of that monthly cash flow, the local government wants $3,000 a year in property taxes. The insurance company takes another $1,500. In year 2, his tenant moved out, leaving the place empty for exactly 1 month. Those $1,800 instantly evaporated. And in year 3, the roof starts leaking. A $2,800 repair he didn't budget for, didn't plan for, and had no choice but to pay for. Simply gone. Jake isn't making passive income. After the brutal math, he's clearing maybe $2,000 to $4,000 for the entire year. And the worst part is that he's paying a massive time tax. He's spending his nights and weekends screening tenants, taking emergency phone calls, and working a second job he never asked for. Let's talk about Jake's passive income. Gurus claim expenses only take half your rent. In reality, they devour up to 70%. Jake's $1,800 a month gets completely shredded. $3,000 a year in property taxes, $1,500 in insurance. One empty month costs him $1,800 in lost rent, plus $600 to clean and relist. And the rule nobody tells you: budget 1% to 2% of the property's value every year for maintenance. On a $250,000 house, that's up to $5,000 annually before anything goes seriously wrong. And after all that, Jake's actual return is a miserable 3% to 5%. On the other hand, Marcus hasn't plunged a single toilet. He just lets the stock market do the heavy lifting. And by year 10, Marcus's strategy does something that should terrify every real estate investor. This is exactly where the math gets incredibly deceiving. If Jake looks at his balance sheet at the end of the decade, he feels like a financial genius. His $250,000 property is now worth around $335,000. Because of the sheer power of leverage using the bank's money to grow his wealth, his equity has exploded to over $170,000. He was able to raise the rent a few times over the decade, but his property taxes and insurance premiums spiked right alongside it. Even after the cost of renovations, the property taxes, and the vacancies, he has scraped together roughly $30,000 in cumulative net cash. The real estate playbook worked. But here is the catch. Jake has essentially bought himself a highly stressful part-time job that pays him pennies per hour. Over the last decade, he has sunk hundreds of hours into dealing with contractors, screening tenants, and losing sleep over mortgage payments. Worse, all of his wealth is trapped inside a single, illiquid building made of wood and drywall. If the local market tanks, he goes down with the ship. Now let's look at Marcus. Marcus is finally experiencing the eighth wonder of the world, compounding. By year 10, Marcus has steadily invested a total of $86,000 of his own cash. But his portfolio isn't 86 grand. It has ballooned to a massive $180,000. The curve is no longer a straight line. It is violently accelerating upward. He's earning returns on his initial money, returns on his monthly contributions, and returns on the returns he made 5 years ago. Gains on top of gains. At the end of a decade, Jake and Marcus are practically neck and neck in total net worth. But the reality of their lives couldn't be more different. Jake is exhausted, highly leveraged, and his money is locked behind a brick wall. Marcus is perfectly diversified across the top 500 companies in America. His money is available at the click of a button, and he still hasn't spent a single second of his weekends playing landlord. But as we enter the final decade, everything is about to change. Year 20. The timeline is up. It's time to declare a winner. Let's look at Jake. Thanks to 2 decades of steady appreciation, his rental property is now worth roughly $500,000. He has successfully built over $400,000 in pure equity. Because over the 2 decades, his transient tenants systematically paid off his entire loan for him, plus another 50 grand in cumulative lifetime cash flow. It was an absolute grind, but the real estate playbook worked. But let's look at Marcus's totally boring index fund. Over 20 years, his total out-of-pocket investment was just $122,000. But because he never interrupted the math of compound interest, his portfolio has exploded to over $450,000. And if Marcus got a single promotion and bumped his monthly contribution to just $500, he's sitting on over 600 grand. Now, the brutal reality of inflation is going to eat away at the purchasing power of both Jake's property and Marcus's portfolio. But the raw numbers don't lie. On paper, the final net wealth is practically a tie. But look at the brutal reality of how they got there. Jake traded thousands of hours of his life, took on massive debt, and trapped all of his wealth inside a single illiquid asset. Marcus matched Jake's net worth, but he did it with absolutely zero effort, perfect diversification, and the ability to cash out with a single tap on his phone. Real estate won the battle of leverage, but index funds won the war of time. But before you run out, sell your house, and dump everything into the stock market, we need to talk about the terrifying reality of Marcus's strategy. Stocks might win the 20-year math test, but they demand a stomach of absolute iron. What the spreadsheet doesn't show is the 2008 financial crash, where Marcus would have watched 37% of his net worth completely evaporate in a matter of months. At that point in the timeline, that's roughly $55,000 gone. Index funds don't hand you a monthly salary. They offer zero leverage and absolutely no tax cheat codes. Jake, meanwhile, gets to write off thousands in depreciation every single year on a house that is actually going up in value. And he can eventually use that 1031 exchange to defer capital gains forever. Real estate isn't a passive investment, it's an active business. And for the right operator, that is its greatest strength. If Jake uses strategies like house hacking or buys in a specific market with a massive 1% rent-to-price ratio, he absolutely crushes Marcus. Historically, raw, unlevered real estate only grows at roughly 3% a year compared to the stock market's 10%. But the exact second you introduce the bank's money and master the art of leverage, the entire game flips. So who actually wins? Well, neither. The real winner depends entirely on what you value more, control or freedom. Real estate gives you a tangible, highly leveraged asset, but it brutally taxes your time and sanity. Index funds are a passive, compounding powerhouse, but they demand an iron stomach during terrifying market crashes. The ultimate cheat code for better returns is to stop investing blindly. Evaluate your risk appetite, run your own math, or better yet, diversify and do both.